So let me tell you guys, I guess, the ending of where the developers actually end up when they're not marking to market, right? When the lender's not marking to market. That's a fancy way of saying that the value of the loan right now is 50. The value of the loan, meaning the debt itself, is 80. So they're not selling it at 50. They're trying to still get their $80 million. So what's happening with these lenders are they're trying to decide whether they're going to dispose of the asset, number one, by themselves, and they're going to Bob Knackel at JGL and trying to sell it. And he's like, look, this thing is underwater. So Bob Knackel pings it back to me. And I'm like, you know what? I'm going to go to a new developer and see how much they can create value. So I ping it back to Rich, and Rich is like, Leo, I can't do anything with this unless you get the bank to take 25% of the value down. And I go ping it back to Eric, and Eric is like, well, I can't get the capital if you, again, get him back to 25%. But it seems like the lenders are having trouble understanding that. Instead, what they're doing is, and I just came out of a mediation, it was a $76 million property, a huge property, I believe, in Brooklyn. 60 units, I believe. It was about 60 units. It's probably a rental play or a condo play, I forget. But the value of the land right now is $15 million. 2 years ago, a year and a half ago, was $37 million. So think about it. You have a lender that already has funded 37 out of $76 million loan, aggregate would be $100 million value post-construction, is now dealing with the property. It's $15 million.
Half built.
Well,
Half built.
That's what I wanted Bob to elaborate on. Just for a second, for those that don't understand, you mentioned something about the value of the building and a 60 and a 20. Can you just elaborate for those that don't understand that there's something called a debt service coverage ratio, and the more the capital costs us, the less the debt service coverage will be reflected. A lot of people don't understand that when you're refinancing, it's not just what the building is worth, but there's a formula that needs to be applicable to the bank, which will then go back to what you're saying, AKA margin call, right? Banks
a huge margin call.
There are hurdles that you have to achieve. And so there's being in default because you're not paying. Then there's technical default because your debt service coverage ratio isn't there. Because if your new mortgage rate is so high, it's going to eat up more of the cash flow. Your debt service coverage goes down.
What else is higher today?
Pardon?
What else is higher?
Insurance.
Yeah,
Insurance.
Everything is higher today. Look,
right.
Tell me. Look at Class B and C office buildings. Anybody would say, today they're trading between $250 and $350 a square foot for B and C office buildings in the Garment Center.
But what were they trading?
Give us what they were trading. For $600, $700, $800 a foot.
Even $800 a foot.
And so you look at that, and then Department of Finance comes out with the tax assessments. Tax assessments on those buildings went up 3.1%, according to the Department of Finance. So I want to sell all my office buildings to the Department of Finance since they think the value went up as opposed to
Well, let's just go
down.
back to that example. So think about it, $800 a foot on a net rentable, right? You can borrow, people talk about it all the time. If you had borrowed 50%, which you and I would have said is actually very low leverage on an asset.
Yes.
Just
Great
based on the
Yes.
value he's saying, it's now $250. Right in there is where the issue is. That
money.
bank is the one who put in the 50%, and now they're underwater.
But how are they?
Let me give you a real life example because I have a client that owns a very, very nice Class C plus building, Midtown West. Got a loan 5 years ago. He was getting rents in the high 50s to $60 a foot. 94% occupied, had an appraisal for $210 million, took out a $100 million mortgage.
That's less than 50.
Very conservative, less than 50. Today, the building's 34% occupied.
Yeah.
The last lease he made was at $29 a foot.
Yeah.
The mortgage is maturing.
It's getting crushed.
And the bank said, we'll refi, but we will give you $80 million. And that he has the $20 million. He says, Bob, I'm very lucky. I have the 20,
100%.
but I don't really feel like putting it into this building. So that's a real life example of what happened.
Can I tell you some
yeah,
good news?
Yeah, sure.
Because I don't know if you guys were I know the three of us were there. I don't know if you were there. We were at the Rebney Awards,
Yes, we were.
right?
Great
and
time.
The Rebney Awards happened, and for the first time I've heard in a very long time, the speech from the federal to the state,
To
to
the
the
city.
city,
Yeah.
finally was even talking about saying we need more housing. There's a crisis. Before, that wasn't even the narrative. So I don't know, and you might have more experience than I do. I always see it. I don't even listen because I think it's all BS. But imagine now, maybe, just maybe, they're actually thinking about trying to resolve what Richie is saying, what we're saying, not about valuations, just saying we have a housing problem. We need to stimulate the developments.
Even for those elected officials that think that an Econ 101 textbook is capitalist propaganda, the fact is, during the pandemic in Manhattan, a lot of people moved out. Vacancy soared. Vacancy soaring is like supply increasing. Rents went down by 30%. So if politicians really want to make rents more affordable for people, increase supply. How do you do that? The time in which you have to get your TCO is actually June of 26. The banks want it to be June of 25 to give you a construction loan. There's 60, 70,000 units on sites that are to be built, but they're not starting because they can't make the deadline.
Not only that, they can't get the new capital, which we could talk about with Richie too,
Yeah,
right?
they-
You can't, capital's looking through the brand new lens of reality. It moves a lot faster than mid-market. The capital's saying we need this return on our money, otherwise we can make 14% doing this or 17% doing that. You have to entice
selling
us.
watches, selling watches.
Exactly.
People are saying, "I'll give you $1 million, but I can make more selling watches."
Exactly.
This is a competition today.
So tell us, Rich, what you've been doing on the developer side. Give us an example of, a benefit you had 2 years ago that you don't have today in developing property.
All right, I'm gonna touch on this. Let's talk about investors, right? People that have a shit ton of money and they just want to reinvest. What's their end goal? Make money as safe as possible. People like the 421A because it's easy to get a loan on, it's easy to raise capital on, it's easy to build. There's over 10,000 applicants ready to be processed. There's over 10,000 people. If you build a 10,000 apartment complex, you can fill that in 1 hour. That's how many people the city's holding back on reserve option that ready approved applicants. Like you build it, they send you 10,000 people. Now think about the two lines I told you about. Free affordability 70-30, which are the more higher sophisticated clients. And then you have HPS. On 10th Avenue, there's a shelter. They're taking them from 10th Avenue, homeless people, putting them in your apartments. They're giving you a 30% premium, and they're giving you a direct deposit on the first of every month. The city of New York. You never see the tenant. Now, here's the biggest benefit. Is those units that we're building, let's say, on average $250 a foot, those units that were being built for $250 a foot, the HPS units that you're building them at $200 a foot. Because you know that you're building them for a homeless client. You're not going to put a chandelier. You're going to put a regular hi-hat. You're not going to put a 24-inch.
Let me ask you though, how many units are being developed? I don't even hear about this. How many units are being developed under that?
HPS?
Yeah.
All of Bronx, all of Jamaica, all of Ozone, anywhere that you can't get a market rent above 2369 is a specific number so that it wouldn't get rent stabilized.
I have a question. Where's the government not have their hand in policy? I'm hearing about HPS,
market.
421, free market, but how is free market doing right now?
Zero. Rentals, nobody's building it because you're going to spend between 25 and 35% of the average rent roll in real estate taxes.
So how are you supposed to solve the housing crisis?
It's easy, Leo. You can easily solve it. As we said, number one, extend the June of 26 deadline to get your TCO. You'd have tens of thousands of units coming out of the ground within 30 days. If you reestablished the MCI and the IAI program that were both effectively marginalized. I mean, go back to the 1970s when the dilapidation rate in New York was 14%. 14% of the apartments were in such bad shape they were uninhabitable. They put the MCI and the IAI into effect. That produced a great return for investors, and consequently the private sector put tens of billions of dollars into the housing stock. In 2019, dilapidation 0.04.
Now, MCI, though, so the audience understands, is that you would get back for spending money on that dilapidated unit. So it's an existing unit, it's stabilized, but you would get a bonus by putting the work in that would make sense to make that investment. Is that the program you're talking about?
Like the J51.
Yeah, the
Similar.
MCI was building wide. The IAI, individual apartment improvement, was for the apartment. Put both of those programs back to what they were. There are estimates at the low end 30,000 units at the high end, 80,000 units that are just nailed shut because it doesn't make sense to invest in them. Think if you reinstituted both of those programs, all of those units would be under renovation within 2 weeks. How many sinks are you going to sell? How much flooring? How much sheetrock? How many toilets? How many refrigerators? Give me a break. How economically stimulative that would be. Bring back the 421A. Create implement a 421G program that works so beautifully downtown. 9/11, we had 1,800 dwelling units down in the financial district. Today there's 30,000 because of the 421G. You want to convert older obsolete office buildings to residential?
Beautiful.
Do a citywide 421G. All of these things, so simple. When you do them, all of a sudden, you want rents to come down to be more affordable, do these things. Yet every politician will not get on board with this stuff.
And here's the biggest problem, by the way. The city of Florida, Miami, is booming. We're missing out on all the money. When they're going to be done building, we'll be reaping the rewards of everyone moving out. When it's time for us to rebuild, everybody will be already in Miami.